party may well be over for the stock market.
It's over. We are screwed.
In 2025, the S&P 500 has fell 10% from its all-time high in February 2025.
There was a huge plunge on Wall Street on Monday, caused by nervousness.
As a historic day, an S&P 500 that closed lower is down 10% from that all-time high.
Stagflation driving the S&P 500 into correction territory today, meaning it was down more than 10% from its all-time high.
I think your forecast is S&P 500 flat to down 10% by October.
That bull market is over.
Could now be the time to reevaluate, seek alternative investments, and maybe try something different. Today, I'm going to be talking about my top 5 alternative investments to the stock market. Some could be worth millions. Some will seem a little bit wacky, but stick around because I'm sure there are some in here that you've never heard of.
I'll believe it when I see it.
Hi guys, welcome to the channel. If you're new here, I'm Brett. I've been investing for over a decade. Everything from pensions to collectibles and everything in between. I've experienced the pros and cons of boring and exciting investing, and now I want to share that with you. Let's start with something fun, collectibles. Fancy watches, Pokemon cards, vintage stamps, rare coins, fine wine, comics, even Lego. When I was a kid, even Beanie Babies were an investment.
You were also 10 and you thought Beanie Babies were going to help you pay for college.
Now you might be thinking, they're just hobbies. And you would sort of be right, but they can also be serious investments if you know where to look. Traditional investments like stocks and real estate can be unpredictable at times. But when you look at collectibles more broadly, not just that 6 shiny Charizard, but rather consider supply and demand, you quickly realize that collectibles have one thing in common: scarcity. When something is rare and people want it, the value goes up. It's simple as that. This is compounded by generations getting older and wanting to relive their childhood and buy all the toys they couldn't get. I think I might have a problem. When you stop and think about it, they're not making any more vintage Rolexes from the 1960s. A first edition Charizard, only so many exist, and even fewer that are in good condition. And as time passes, demand tends to rise while supply stays the same, or even shrinks. That's why some collectibles see massive price jumps. Take Logan Paul. He repopularized Pokemon back into the mainstream in 2020 by buying a first edition Charizard.
How much money am I holding in my hand?
So you're holding $750,000 right there.
But what really pushed the price, beyond the obvious craze of it all and hype and all the rest of it, was everyone started looking for these first edition Charizards in their cupboards and attics. And it quickly became apparent how rare they were. That then drove the price to even insane heights. Another bonus to collectibles is they're fun. Let's be honest, buying a stock is super boring, but collecting something you genuinely love and have fond memories of, that's an investment that you can actually enjoy. Let's talk about some of the pros of holding collectibles. Firstly, they're tangible. Unlike stocks or crypto, collectibles are real. They're physical items you can hold and admire and even show off.
Look what I got.
Whether it's vintage watches, rare coins, or sports memorabilia, they are yours forever, whatever they're worth. Let's be honest, a collection of classic comic books looks way cooler on the wall than a picture of your stock portfolio. Secondly, they're fun. Collectibles aren't just an investment. For most, they start as a hobby. If you love what you're collecting, you'll enjoy the hunt just as much. Plus there's a thrill of finding that rare shiny card that you've always been after. If the investment tanks, at least you've got something cool to look at and show off. In the UK, certain collectibles can offer tax advantages. For example, some items like classical cars or fine wine or even watches may be exempt from capital gains because they are considered wasting assets. What this effectively means is that they naturally deteriorate over time and thus aren't subject to capital gains. Like with everything, there are cons too, and there are a few when it comes to collectibles. One big issue with collectibles is they can experience wild price swings based on trends, hype, or even celebrity influence. They are volatile. One day everyone wants Pokemon cards or rare sneakers, and the next, the hype dies down. The Logan Paul buzz has well and truly worn off, and the Yeezy brand, well, who knows what Kanye is doing nowadays. Is it Kanye or Ye or I don't know what his name is anymore. Unlike stocks or real estate, where the market tends to be somewhat predictable.
Okay, ha ha ha, sure.
Collectibles can be highly speculative. what's valuable today might be forgotten tomorrow. When I was a kid in the 90s, Beanie Babies were seen as the next big investment. But when the hype bubble popped, most became nearly worthless. And most people either don't remember them or just don't care. Unlike stocks, which you can normally sell pretty quickly on a stock exchange, collectibles take time to sell. You need to find the right buyer willing to pay your asking price.
It's not worth it to me.
Even if your collectible is technically valuable, there is no guarantee you'll sell it quickly or at the price you expect. You might have a rare comic book worth £5,000, but if no one is willing to pay it, you're stuck holding on to it. No amount of praying to the gods will change that. Proper storage is crucial to maintaining value. Collectibles often need to be protected from light, moisture, and physical damage. No letting your 2-year-old grab hold of your rare Pokemon cards. Some high value items even require climate controlled storage, which can be expensive. A Pokemon card in mint condition might be worth thousands, but if it's bent, faded, or has a stain, it could be completely worthless. For me, collectibles have been a big part of my life. They never started as an investment. They were never meant to be. I'm holding them as much to open them with my kids as I am for the future value. They represent my childhood. They represent a simpler, happier time. Will they be worth loads? Who knows, but I like having them. So in summary, are collectibles risk-free? No. You've got to know what you're buying. If there is money to be made, there are counterfeiters out there trying to make money from you. But get genuine and keep it in great condition and be patient. If you play it right, collectibles can be a smart, exciting way to diversify and even grow your wealth over time. Next, let's talk about gold and silver.
I love gold!
When it comes to investing for the future, these two metals have been shining for centuries. So why do people love gold and silver as a part of their investment? Well, imagine your portfolio is like a boat. Stocks, property, even cash, they're all different parts of the boat. But what happens when waters get rough? The economy dips, inflation rises, markets crash. Suddenly that boat starts to rock. That's where gold and silver come in. Think of them like the anchors. They don't stop the waves, but they tend to keep the boat steady over time. Historically, and I will emphasize historically, when markets struggle, gold and silver tend to hold their value or even go up. Just look at the financial crash of 2008. Gold kept rising. That's because, rightly or wrongly, people trust them. Gold is limited in supply. All the gold that has ever been mined would cover a football pitch to the depth of just 1 meter. And unlike digital assets or company stocks, they can't just vanish overnight. The gold is going to be there. I always think there's something quite alluring when it comes to gold. Gold isn't primarily formed on Earth, but rather in explosions of stars in space, with the gold eventually finding its way to Earth via meteorites and other cosmic debris. That's cool, that's mysterious, and it makes it rare. But what about silver? It's not just a store of value, but it's also in everything from solar panels to medical tech. So as the world moves towards green energy and advanced technologies, demand for silver could climb, or at least that is the hope for silver collectors. So what are some of the pros of gold and silver? Well, firstly, gold and silver have been valued for thousands of years and have survived financial crashes. They've survived wars, inflation, and unlike stocks that can plummet overnight, gold and silver historically has been quite safe. Betting on gold and silver tend to hold their value over time. Now, I'll give you an example. Imagine it's 2008, the stock market is crashing, banks are failing, and people are panicking. But gold, its price shot up as investors rushed to find a safe place to put their money. Even in uncertain times, gold and silver tends to be a financial life jacket. Similar to collectibles, gold and silver can be tangible, meaning you can hold them in your hand, and unlike stocks and crypto, which exist digitally, you can have them in your person. There's no risk of a bank collapsing and wiping out your gold. You own it, it's yours, and it's in your hand. Whether it's still worth anything if a bank collapses or all the banks collapse, that's a completely different matter, but it is worth something. Gold and silver are recognized everywhere. Whether you're in London, Dubai, or Tokyo, gold has value. This makes it a way of hedging against local currencies and ensuring it can be bought and sold wherever you are in the world. In the UK, certain types of gold and silver, like gold sovereigns or Britannia coins, they are exempt from capital gains tax. That means if your gold price goes up and you need to sell, you can keep all the profit to yourself. That all sounds great, but what about the cons? Gold and silver don't generate income like stocks do, with dividends or rental properties with rent. They just sit there, waiting to hopefully appreciate in value. This makes them more of a wealth preserving asset rather than one that grows with you. Gold and silver can be subject to capital gains when sold for a profit. There are exemptions, like I mentioned, sovereigns and Britannia coins, but silver is problematic because it is also subject to VAT when it's bought. So you're getting taxed on the way out in, and you potentially are getting taxed on the way out as well. Certain types of golds are not always tax exempt either. For example, gold bars. So ensuring you're buying the right thing can be quite tricky. Physical gold and silver need secure storage, whether that be an in-home safe, a bank, a safe deposit box, or a professional vault. Gold and silver stored at home carries theft risk, while professional storage can eat into the profits that you're hoping for. People can easily get caught out by realizing home insurance doesn't cover their gold and silver, or that bank vaults charge 150 plus a year to store. For me, I personally invest in gold funds. They're not specifically tangible gold, so I guess I don't get all the pros, but they give me portfolio exposure to this asset. And I think in the longer term, that will always end up as a positive. Whether you're a first-time investor or just looking to diversify your portfolio, having a little gold and silver can potentially aid you ride out some storms. It's not about going all in, it's about balance, a safety net, a little insurance policy for the future. A lot of people will shy away from gold and silver. In my opinion, silver is more speculative, but I don't see gold suddenly becoming worthless. There is a question of its value against stocks or housing, but we aren't talking about going all in on gold. Rather, having some as a part of a diversified portfolio can only be a positive for the long run. Let's move on to money market funds. Think of a money market fund like a high-end savings account that tries to work for you. It's a pool of safe, short-term assets, things like government bonds and corporate debt. These tend to earn a little bit more than your average interest at a bank account, but without the potential ups and downs of the stock market. They're a great balance. If you're looking to keep your cash on the sidelines for a future purchase or whatever other means you want the cash for, money market funds give you a place to park some cash while still earning a return that beats most banks. Let's look at some of the pros of money market funds. Firstly, they're steady. While stocks can be up one day and down the next, money market funds are designed to be stable. They won't make you rich overnight, but they won't also give you a heart attack from day to day. Next, they're liquid. That's a fancy way of saying that you can access your cash quickly if you need to. There's no waiting around for the right time to sell, and they generally will be able to get the money out quite quickly. Money market funds often offer higher returns than traditional savings accounts at banks. Banks tend to offer low interest rates on savings, whereas money market funds invest in short-term, low-risk securities that can generate better yield for the short term. But there are always negatives. Money market funds are a low-risk investment that aim to preserve your money while offering small returns. However, the interest they pay may not even keep up with inflation. It might beat the banks, but it might not keep up with inflation. And that means that over time, the real value of your money is still likely to decrease. It's like riding your bike on the road. While inflation drives past you, sure, you're moving, but you're still falling behind. Unlike a regular savings account, money market funds are not covered by the Financial Services Compensation Scheme, FSCS for short. If the fund experiences losses due to poor management or something happens like an economic downturn, you could lose your money. While the risk is low and it's designed to mitigate those risks, it's not zero. It's like storing your money in a piggy bank made of thin glass. Looks secure, but one good drop and oops, we made a mistake. There goes your savings. No protection. My biggest issue with money market funds is the missed opportunity cost. It's a bit like cash. If this is where you want to store your emergency fund, then fine, but as a long-term investment vehicle, it's probably my least favourite option. If you need to hold cash and you have room in your ISA allowance, this is how I would do it. It's not going to be an inflation beating or even make you a millionaire, but it will be stable, it'll be predictable, and it'll nearly be as liquid as cash. Premium bonds. On the NSI website, they say a fun way to save with the chance to win tax-free prizes every month. These are low risk but exciting. When I described premium bonds to my wife, she was in. She wanted an account and wanted to get saving. Premium bonds are essentially a bank account, but instead of earning interest like a normal savings account, your money goes into a prize draw every month and you can win anywhere from £25 all the way to £1 million a month. And the best bit? It's all tax-free. This is effectively a kind of lottery, but the key difference is you never lose your initial deposit because you can always withdraw the money whenever you want. As with all the tips, there are pros and cons. Some of the pros are the premium bonds are backed by the UK government, making them one of the safest investment options available. If you buy premium bonds, you're essentially lending money to the government, which guarantees the safety of your initial investment. If you buy £1,000 worth of premium bonds, that £1,000 is guaranteed by the UK government. So unlike the stock market or other type of investments where your capital could fall, with premium bonds, your original amount is protected. Next, premium bonds are exciting. The possibility of winning anything from £25 to £1 million a month, that's thrilling. The thrill of checking every month what you've won. It's a form of gambling that is exciting. But what about tax? Well, any winnings from premium bonds are completely tax-free. This means you don't have to pay income tax or capital gains on any prizes you win, which can be a major advantage over other investments. Premium bonds are also a popular option for gifting to children. Not only does it introduce young ones to the idea of investing, or saving in this case, but it also offers a chance for them to win prizes. One of the best things about premium bonds for me is that you can withdraw your money at any time, penalty-free. If you want to access your cash, you can do so quickly without any loss of interest or fees. But there are downsides. While premium bonds are often advertised as safe, tax-free investments, there's one important downside. That is, there's no guarantee that you'll actually win anything. The value of your investment doesn't increase over time. Instead, you have to earn your interest via prize funds. Your bonds are entered into a prize draw every month, and this means that you could win the huge prize, but you could and likely will win nothing meaningful. The odds of winning anything significant with premium bonds is actually very low. For every £1 bond you hold, there's a chance of winning a prize about every 22,000 to 1. While you can win up to 1 million, these big wins are extremely rare, and most people will only win the smaller prizes. And some, if not most, will win nothing at all. For every millionaire that wins, there needs to be a lot of people winning nothing to pay for it. Another downside of premium bonds is that they're not inflation proof. The value of your bonds doesn't grow over time. So if inflation rises, the purchasing power of your money could decrease. Even though you could win prizes, these might not even keep up with inflation, meaning that after a few years, the purchasing power of your money might be lower than it was when you even invested. Whilst premium bonds have a lot of positives, I often wonder if keeping it in a money market fund in an ISA is actually a better option. It is better than a bank and offers more guaranteed return just by sticking it in a money market fund. In conclusion, premium bonds are fun, a chance to win big, while keeping your money secure. Are you guaranteed to win? No, but if you've got some spare savings and you want a no-risk, tax-free way to keep your money parked, premium bonds could be a good way with a bit of an added entertainment along the way. Tip number 5 is something that might sound a little futuristic, but may actually be a smart move for diversifying your investments. That's cryptocurrency. I know cryptocurrency has a reputation. Some people think it's a gold rush, others think it's just magic, and it's probably both.
It's all a fugazi.
Crypto is a digital age currency and thus a potential investment. Unlike stocks or property, which are tied to old school systems, crypto is global. It runs 24/7 and doesn't depend on banks or governments in quite the same way. It's essentially the internet of money. It's still young, which means there is potential for big growth, but also there's potential for a lot of volatility. It's a bit wild and untamed, kind of like the early days of the internet. But like then, those who understood it early did pretty well. Before we get into the pros and cons, I'm not an expert in crypto, but here are some of my pros. Crypto offers a unique way to diversify your investment portfolio. Unlike traditional assets like stocks and bonds, crypto assets don't always move in sync with the stock market, which can help reduce the risk of your overall portfolio. But it's a relatively new asset class. Its value may be driven by different factors than traditional investments. We'll get into that a little bit more when we get to the cons section. So let's have a look at an example. Let's say you've got an investment in stocks, real estate, bonds. Adding a small percentage of Bitcoin or Ethereum or any other crypto that you might like to your portfolio could help protect against losses if the stock market was to dip. In 2020, for example, while stock prices were falling due to COVID-19, Bitcoin saw a significant rally, providing investors with an alternative source of potential growth during uncertain times. Next, unlike traditional financial systems controlled by banks or governments, cryptocurrency operates on something called blockchain technology. This means that no single institution has control over the currency, making it less vulnerable to manipulation, centralized failures, or government intervention. This decentralization can appeal to people who want to take more control over their money. Next, crypto aren't restricted by geographical borders. This means you can send and receive funds anywhere in the world without worrying about exchange rates, fees, or trading banking hours, for example. This feature makes crypto especially useful for international transactions, opening the doors for people in countries with limited access to stable banking systems. Now, many would say there are a lot of cons when it comes to cryptocurrency, and I would tend to agree at the moment. Firstly, crypto operates in a relatively unregulated market compared to traditional assets. Counter to the pro, this can be seen as a con too. While some countries are starting to introduce some regulations, the overall global framework is quite inconsistent. This lack of regulation can lead to some issues such as scams, lack of consumer protection, and the possibility of regulatory crackdowns in the future. An example is in 2017, China banned initial coin offerings and cryptocurrency exchanges, sending the global market into a brief panic. This lack of clear regulatory frameworks can make crypto unpredictable and risky for investors. That unpredictability is demonstrated in what most people know crypto for: their extreme price fluctuations. While this volatility can present opportunities for significant gains, it also comes with a risk of big losses. The price swings are often driven by speculative trading, news, social media buzz, rather than the underlying value of this particular asset. A good example of this is Bitcoin's price hit an all-time high at the time of nearly $65,000 in April 2021, only to crash to below $30,000 a couple of months later. Such rapid changes can be quite unsettling for investors, especially those new to crypto. One of the worst things is the cryptocurrency market has seen incidents of market manipulation, particularly around meme coins. These coins are often driven by social media trends rather than fundamental value, and sometimes groups or individuals can artificially inflate the prices through coordinated efforts. Dogecoin, originally created as a joke, saw its price soar in 2021 due to high-profile endorsements, including tweets from Elon Musk. While it gained a massive following, the price also fluctuated wildly, with some people claiming the market was being manipulated through hype-driven social media activity. And somehow, it's now even turned into a government agency under Donald Trump. So cryptocurrency. Some consider crypto as the hedge against traditional finance. If inflation eats away at the cash or markets take a hit, crypto moves differently. Sometimes up, sometimes down. It's just another tool in the toolbox. This is the intention of crypto, but it's still currently tied to traditional financial means. In today's economy, it's near worthless without the ability to exchange for traditional currencies. The number of places that accept crypto are limited, but they are also growing. Is it risky? Absolutely. You wouldn't really want to throw all your money into it, just like you wouldn't want to put all your money in one stock or one property. But I think crypto is a necessary investment in my portfolio. Not substantial, but I think not having it, I may regret that in the future. I want to invest enough to ride the wave if it does go up, but not too much that it has any impact if it was to go to zero completely. So whether you're a crypto believer or crypto curious, it's worth keeping an eye on because the future of money might already be here today. Get some skin in the game if you think it's for you. What the heck, we're here now. Let's throw in one more for a bonus.
Bonus time is just around the corner.
One of the best investments you can make, it's not stocks, it's not real estate, it's not even gold, it's you. Investing in yourself is hands down the smartest move if you want to build wealth and a better future. Just think about it. Every skill you learn, every course you take, every connection you make, sounds like a song from the 90s. A P. Diddy reference in 2025 probably isn't the best option, but I'm rolling with it.
Keep on rolling, baby.
All these things are like adding interest to your own value and your own worth. The more you grow as an individual, the more opportunities that will come your way. Want to start a new business? Well, upgrade your skills. Want a higher paying job? Learning something new. All these things contribute to your overall value. If you want to have more control over your future, bet on yourself. And yes, even investing in yourself has pros and cons. One pro is whether it's through developing a new skill, gaining a new certificate, or pursuing a passion, a new skill can lead to a new income stream. A side hustle can be a significant boost in your financial stability while you're giving you more control over your future career. Next, developing new skills and knowledge helps you stay adaptable in an ever-changing job market. AI is going to take over the world, but by investing in yourself, you can pivot and adjust to different industries or job roles with ease. Investing in your personal development can improve your mental health by increasing self-esteem, confidence, and personal fulfillment. Focusing on personal growth can reduce stress and anxiety about the future. A big one for me is it serves as binge protection, meaning it safeguards you from burnout from the norm or falling into unhealthy cycles of procrastination or unproductive habits. Or in my case, it just saves me from binge watching YouTube and Netflix. And finally, investing in yourself can lead to enriching life experiences, whether that's through traveling for education, learning new languages, or just taking on new challenges. These experiences can contribute to personal growth and can make you feel more fulfilled in your life. And yes, there are cons, and the negatives here are quite simple. While investing in yourself can have high returns, there's no guarantee of success. Unlike traditional investments like stocks, where there's a historical trend of growth, investing in yourself depends on many unpredictable factors, such as market conditions, personal motivations, and maybe external opportunities that may come about. The financial cost of investing in yourself can be significant, whether it's in the form of formal education, certificates, workshops, or one-to-one coaching. These costs can quickly accumulate, and if the investment doesn't pay off, it could be financially quite burdensome for you. Even though it can be seen as an investment for the long term, the upfront cost may and will be a barrier for some. The best part about investing in yourself, it's the one investment that no market crash, no inflation, or economic downturn can take away from you. Whether it's learning how to manage your money, picking up a new skill, or just taking better care of your health. These will pay off for your whole life. So if you're looking for a future-proof investment, don't just look at the stock market, look in the mirror, look at you. You are your biggest asset. Now, there will be links and references to everything we spoke about today in the description down below. None of this is intended as advice, and sometimes we can focus too much on maximizing and forgetting that investing can actually be quite fun. If you found this video helpful, make sure to hit that like button, subscribe for more money tips. Comment down below how many movie references did you catch, and bonus points if you can name them too. For now, stay smart, stay savvy.
You stay classy, San Diego.
Keep growing your money, and until next time, happy saving and see you soon.